generally speaking, most assets that are in the space are probably overvalued, just given like the level of how early we are and speculative nature of the environment, and the fact that almost no participants in the public liquid crypto markets are fundamental investors. And so that means that you have to play the game that's being played. And today that is very much not fundamentals like it is in value investing for stocks. I think it gets there, let's say 2 to 3 years, and our strategy will adopt to that, and we will continue to do more and more. It's already increased from 12 months ago to today, how much fundamental work is being done. But if you step back and kind of have that view that generally the space is kind of, from a protocol basis, a lot of froth and overvalued, we then believe that macro liquidity dictates most of these assets.
Let's do it. Quinn, thank you so much for coming over. Excited to make this podcast finally happen.
Yeah, likewise. Good to hang with another Miami neighbor.
I know. We're growing the Miami crew slowly and surely, but a lot of exciting things that are now happening in Miami.
That's right. I mean, I just read a tweet that said Miami has the highest number of skyscrapers being built, more than any North or any East Coast city combined, or something like that. So we'll see.
Well, they're building a 66-story building next to my place, so I'll have people looking at my apartment soon. I definitely believe that. But I think what you're doing is super interesting within the crypto space. You're starting a hedge fund, and it's a crypto hedge fund, but you're also focused on macro. And I think historically, crypto funds have kind of either been long, short, kind of thesis driven, but not very many people include kind of macro outlook, at least not, I would say, historically. And so I think your fund is really unique because throughout the, say, 2023 and even today in 2024, I've been following your Twitter more, you've been tweeting more, and a lot of your calls have been really fucking cracked. So congrats on that.
Thanks. Appreciate it.
But your story, I think, is just super interesting. And so maybe to start off the podcast, I always like to hear a little bit about people's stories before diving into the details of like your investment philosophy. So maybe give us a little background on how you ultimately came to be with this fund and how you got started.
Yeah, for sure. So I'm from the Midwest, grew up,
Shout out Midwest.
Yeah, exactly. Fellow Big Ten. And, went to school, had no idea really what Wall Street was. Parents, have kind of normal jobs. And in school at Wisconsin, I, was in accounting and finance classes and ended up double majoring and then getting an investment banking internship in New York. So went out to New York for the summer and then went back for my, started my career, spent the first 6 years up there working in investment banking and then fixed income and capital markets roles. And I always loved the markets, just like the public markets, macroeconomics. It's kind of funny because growing up in like elementary school and middle school and high school even I just loved current events. And, that's like meaning sports and pop culture things that when I was younger, and then that morphed into really having a interest in geopolitical events and more, not necessarily political things, but more like strategic geopolitical things and how events would take place and what that meant. And then eventually that makes sense. It shifted to macro because if you have a passion for forecasting these things and maybe taking non-consensus views, the place to make money is not betting on, is China going to invade Taiwan? It's expressing that in financial markets and how things will play out. So it started from a young age. I was always very interested in that. And it kind of brewed through my early career in finance where I was in these credit and fixed income jobs and always had this passion for, the macro side, which wasn't, it was a part of it, but not full-fledged, my day-to-day. So diving in there, I would say, in credit and fixed income roles, you typically are a specialist of the product, debt, capital markets, but you're a generalist across industries. So, and what I mean by that is we were an expert on the capital market side of things and underwriting, and then we leaned on the industry experts, the sector specialists within the firms who knew the ins and out deep dive of each industry we worked on. So at any given time, I was working on oil and gas deals, sometimes media and telecom deals. And that skill set, I think, you cover like 10,000 feet an inch deep type of thing versus like, a small radius, but very deep. And it teaches you to like be able to get up to speed quickly on a number of topics, be aware of all, kind of your periphery of potential things that could influence or become knock-on effects. And, from there, I had this passion for macro and how things would play out. A little bit was like the monetary policy experiment. Now it's not as much talked about because QE is so accepted, but for the 2010s, it was all about your headline every single year was like, can QE and monetary policy continue at 0% interest rates? Can 0% interest rates continue? And it was a global thing. And, these things tend to move in unison across the world. So that sparked my interest, got into Bitcoin into like in 2019, 2020, actually through Real Vision is really what sparked it. I know a lot of people went that route, but it was the first kind of financial media research, publication that married the two. And at first, like everybody else, I'm working in New York on Wall Street every day and have Real Vision pulled up on my screen, and they're talking about Bitcoin and crypto. And, obviously Raoul Pal is a very established traditional finance guy years ago and worked in hedge funds, but it still was that like, fringy media source. It wasn't like, it wasn't, your Wall Street Journal or anything like that. People still were skeptical of it. Oh, they're just pumping, Bitcoin and stuff. And so I definitely had that view like every TradFi person at the beginning, and then got deeper and deeper. COVID hit. Instead of going in the office 6 days a week, I, had all this time on my hands that I wasn't commuting and got into crypto big, and then went full time in 2021. So it's that background that's kind of shaped my investment, philosophy and approach to the space, and maybe unique, edge, of how I see the world.
Yeah, it is fascinating. I think being able to synthesize a lot of ideas and intelligently try to make predictions about that is really a superpower. I mean, it is really, really hard to, I would say, digest that much information and actually be able to synthesize that and how they all come together, and doing something with that outcome that's useful, and then being able to kind of see what's going on. I was also a big fan of Raoul Pal and his content, and just getting people open to the ideas that there's something else out there outside of like the traditional markets, outside the traditional markets, and exploring this new asset class that is crypto. I think everybody starts to kind of get in with Bitcoin, and then you go to Ethereum, and then you're like, oh shit, like there's actually a lot out here.
Yeah. So the fund and strategy kind of revolves around this as well. But so Lekker, I would consider it a global macro discretionary hedge fund. And I'll get into the crypto part, but at the core, it's discretionary macro. We, our approach is generally a concentrated portfolio, usually picking somewhere between 3 to 5 themes, like a traditional macro approach would, that you believe strongly in and are kind of secular themes that you expect to play out over a, say, 12 to 36 month time horizon. And then within those themes probably have anywhere from 5 to 10 line items or assets that you're picking as your winners if that theme prevails. I would consider, the crypto part of the strategy, which is the bulk of it, is more just a reflection of our view and belief, which is crypto is the preeminent emerging market in the world today. So we kind of view it in that lens, which is just like you would a sovereign like India or China coming onto the global scene, and the capital flows, the liquidity, the economic growth, the population growth, the activity, imports, exports. I think you can basically view the crypto economy as such. And the only difference is instead of a sovereign, it's a network state, kind of like how Balaji talks about it. But that's the approach. And so with that, we're generally of the belief that if you have a convicted macro view on whatever part of the environment that might be, the best expression is probably from a risk-adjusted reward perspective in crypto somewhere. You can just look to Bitcoin's Sharpe ratio and the historical return, risk-adjusted returns of the asset class. So, that's the lens. And then, at a more granular perspective, the view on crypto is like maybe zeroing in on Bitcoin as I view it as a commodity. I used to do a lot of work with oil and gas and energy companies in TradFi. And that's really informed a lot. And how commodities work is they're very, very cyclical. They're not like stocks that have internal compounding that's growing enterprise value. Your earnings base is growing and you have a multiple on that kind of ebbs and flows. It's you don't have that cash flow in the commodity. Obviously, there's other assets besides just Bitcoin. But with that commodity-like approach, it's extremely cyclical. It's either in vogue or it's out of vogue. And you can, for example, be the best oil analyst in the world, picking the winners and losers of oil companies. But if we're in a terrible recession and oil's falling through the floor, you're picking nice houses in bad neighborhoods, and it's going to be a struggle. You might outperform your benchmark, but you're not going to outperform other assets. And so that's the kind of approach. I'm the biggest investor in Lekker, and that's how I view allocating capital. Is I generally want to be long crypto because I think it is this emerging market that's going to dominate and be the quickest grower in the next 10 years. But there's periods that are very unsupportive for the asset class, to the point where we will be out of the positions completely if things have run too far based on where we see relative value. So the example there is going back to the oil patch, which oil is a commodity that powers energy and basically the modern society. A big reason why the U.S. is such a prolific services-based, tech-based economy is because we have extremely cheap energy, low cost of electricity. You look at many other countries that are net importers, like a Japan, who have a really struggling economy. So I view Bitcoin in particular as the purest form or commodity to express hedge against currency debasement. And so there's periods like 2020, 2021, where governments are going wild post-COVID, printing, and currencies across the globe are debasing. And then there's periods like 2022 where it's actually the opposite, and these officials are acting a little more responsibly, not completely responsible, but enough to kind of drain out the speculation in crypto. And so if you think that's the case, there's these different environments where it works really well and doesn't work so well. And so we're trying to structure, obviously we have our really positive view on crypto long-term, but then other bets and themes within the portfolio that might offer a positively carrying hedge against that view.
Yeah, it's a great point. And I think one thing that you kind of mentioned that stood out to me is just the emergence of crypto as an asset class that is actually deserving to be called an asset class. And it's interesting because crypto, really was so small. It just started out with Bitcoin, then Ethereum expanded that with smart contracts, and now you can build these applications on top of it. And Bitcoin today, I believe, is above $1 trillion. And then we have Ethereum and other smart contract platforms allowing you to build applications. When you're kind of with the hedge fund, are you generally kind of looking at applications built on these blockchains? Are you trying to get broad exposure to different themes, whether that's smart contract platforms or just Bitcoin? How are you thinking that also, I guess, in terms of macro as well?
Mm-hmm. Yeah, so the macro informs macro rules the whole process. So the thing about that is we're taking less fundamental views at the moment on like a long-term buy and hold approach to other assets, like non-core, non-major assets. And the reason for that, we'll probably talk about it later, is there's, generally speaking, most assets that are in the space are probably overvalued, just given like the level of how early we are and speculative nature of the environment, and the fact that almost no participants in the public liquid crypto markets are fundamental investors. And so that means that you have to play the game that's being played. And today that is very much not fundamentals like it is in value investing for stocks. I think it gets there. Let's say 2 to 3 years, and our strategy will adopt to that, and we will continue to do more and more. It's already increased from 12 months ago to today, how much fundamental work is being done. But if you step back and kind of have that view that generally the space is kind of, from a protocol basis, a lot of froth and overvalued, we then believe that macro liquidity dictates most of these assets' value. And under that approach, if we believe to be in a positive macro environment, we'll go risk on. If it's a mediocre and risk-taking environment for crypto, we'll probably just be in the majors like Bitcoin, ETH, Solana. And then if we think it's no bueno, then we'll just be in cash or, into the other macro bets. But we will invest in protocol, application layer, altcoins. It's never 100% of the book. It's usually even 50% of the book, but it will max out probably 30 to 40 if we're in a really positive environment. Q4 23 would be an example. I think actually probably coming up is another example where we're getting pretty constructive.
So on that point, I think hopefully people now have a little bit of background context on you, kind of the fund overall. Where would you and I think you kind of touched upon this throughout, but we're much different kind of, in my opinion, probably macro landscape than 2021, where COVID happened in 2020. You turned the printer on, things went burr, crypto prices were extraordinary. Then we had a variety of kind of cool off reasons, FTX collapse, Luna collapse. On the crypto side, maybe paint like a broad picture of where we are today post-COVID from the macro side, and like where we are today or perhaps where we're going in the next 6 months.
Yeah. So taking a step back to kind of frame it is, Bitcoin started because of policy, government intervention, and really centralization. So we always talk about decentralization, and at this point it's just regurgitated so much you don't really know what it means. But if you take a step back from a macro lens, I always find it funny how things that are talked about in crypto land are actually very applicable to many parts of traditional finance system. And, it's just another building block of our views. But basically the 2010s up to COVID, we had a very centrally planned monetary policy. So if you think of the two levers of the economy, it's not just all centrally planned, but monetary and fiscal policy. So the currency and liquidity is generally dictated by monetary policy, and then how governments spend and finance themselves is dictated by fiscal policy. And in the 2010s leading up to COVID, we had a tremendously accommodative monetary policy because we were in this structurally deflationary environment that basically didn't produce any repercussions to free, easy 0% interest rate money. It was this anomaly, which was largely attributable to China. They're coming onto the global landscape of cheap labor, cheap goods, and all the developed nations at the time, primarily US and Europe, but US was a huge beneficiary, was importing deflation. So China was doing two things. One, producing a ton of cheap goods, exporting that to countries like the US where labor was more expensive. So just importing it alone, we had an advantage on cost. And then also they kept their currency very, very, very cheap and devalued. So this like double whammy of labor was already cheap there if you just didn't intervene on anything. And that would be importing deflation into the US. But then they kept their currency even cheaper, purposefully devalued it to grow their exports on a global scale. That magnitude is, I still think, greatly underappreciated in today's kind of economy macro perspective, and how deflationary that force was. So the US, Europe, every central bank basically was on this global easing, path, and no repercussions. No one thought inflation could even exist again because we had technology, lower costs, all these things. And it really, there's other factors besides China, but that was the primary, probably 75% of it. Fast forward, so we had easy monetary policy, we had China's, exporting deflation to the world, and why we didn't have that great of growth in the US. So fiscal policy, which is government spending, was pretty responsible. We were running small deficits, but nothing crazy, maybe 1% to 3% as we were going in and out of recessions. Fast forward to COVID, and you had all of a sudden those extremely structurally deflationary pressures overnight essentially switched to inflationary pressures. Meaning, so one, we went from China, being the global powerhouse of the economy, we immediately pivoted to an anti-China, generally adopted view, both in the US and other Western developed world. And the reason for that was a lot of brewing populism things, like in our home states in Indiana and Wisconsin, people getting unhappy with, the middle and lower class not keeping up. So the tinder was there for the spark, that all you need. And COVID was what did it. It gave a very easy thing for people to rally behind as China started this, huge global pandemic, and they're the bad guy and they've been ripping our faces off for a long time. So it kicks off this narrative of anti-China, which now is probably the most agreed upon bipartisan angle in the US and many other countries. So we went from accepting China's deflation via exports to now rejecting it. So this whole big driver of the 2010s deflationary period that allowed us to have super, super easy monetary policy and debase the currencies is kind of gone. The next step then is the fiscal response to COVID. Oh my God, this is the biggest emergency we've faced as a nation, as a world since since people were saying worse than the Great Financial Recession, and since kind of the Great Depression. So what do we do as governments? It's our duty to respond to protect our people, and that's fiscal stimulus. We need to hand out unemployment checks that are bigger and in size than what people were making even when they were employed. Stuff like that, that's just absolutely ridiculous, but has been normalized now. And so what started as 3 free money, $1,500 checks in the mail has now turned to all these other, the Inflation Reduction Act and all of these other government spending programs. And it's resulted in, in the 4 years since COVID, we've ran 5 to 7% plus fiscal deficits, meaning as a percentage of GDP, the government is spending 5 to 7% more into debt per year. So if you just think about that, you're like, okay, GDP is, $1, let's say, and the government's every year spending an extra $6 per year than what they're bringing in, and they're financing that with debt. We should be growing GDP as a percentage, like in this close to that 6 number, right? So that GDP growth rate of a nominal 6% that you can assuming they're not just like the worst allocators of capital.
That's giving them a lot of credit.
It is. So let's say it's 4%, 5%, but that's a nominal number. So your economy could be growing 0% real GDP, but 5% inflation per year, or you could be growing 5% real GDP and 1% inflation, and that gets you to that nominal growth number. Today, it's like we're growing at, say, 3% real and, like 3%, 2 to 3% inflation, and we're getting to this 5 to 6% nominal growth. So that's the stage of why things were the way they were before COVID and why they are now. And then diving into the specifics of 21, so we had that huge response to COVID from fiscal and monetary through the end of 21. That was the bubble of all bubbles in tech, AI, or before AI really, but tech and Zoom and every stay-at-home kind of software, crypto. And then it became very apparent inflation was a problem. The government had to do something, and they started to restrict monetary policy. That's where the Fed came in, hiking rates at the fastest clip ever because they were very, very, very behind the curve. But that's how they are. They don't predict and forecast. That's what we do. They react. And so you consistently have this lag in policy anywhere from 6 to 12 months. Like they're always late. That's their job, to be late, to react. And so you had 2022, which was a very restrictive year for monetary policy, but it was still supportive for fiscal. They were still spending 5 to 6% per year. And that's why we didn't see a bad recession. Normally people are like, we hiked rates from 0 to 5, fastest ever. Why is there no recession? Well, it's very hard to go in a recession when the government's still spending 5 to 6%. There's this base floor level of demand. And you heard a lot about the two-speed economy, Main Street versus Wall Street, where Wall Street had a recession in 22, but Main Street was fine. Jobless rate, everything was okay. Oil prices were actually higher, and demand was fine. Up until fall Q4 2022, when there was a liquidity crisis in the European UK bond market and, in fact, somewhat in the US bond market. And then again in March 23, we had the regional banking crisis. That was that cycle's version of the pain needed to stimulate government response, basically, where European and U.S. Central bankers and Treasury officials like Janet Yellen said, this is too much pain. We're kind of done with this restrictive stance. And since those were really the bottoms for risk assets for a meaningful amount of time, because they let their foot off the gas, the restriction got too tight, and it led to, the banking system would have literally collapsed completely if they didn't, in 2 days' time, completely patch it over, equivalent kind of to GFC. The GFC, they just let go longer and the issues develop more. So here we are back to today where inflation has come down because inflation's cyclical, but we're reaching a bottom. And in classic, behind the ball fashion for these policymakers, just as we're reaching this bottom in inflation, which coincided with Q2 being a bad quarter for liquidity. There were some things around the edges, taxes, that was a big suck on liquidity. And we also had this kind of soft patch in growth, but is now inflecting back. Inflation's bottoming. You're seeing kind of oil prices and commodities bottoming just as we're getting into this easing cycle, because policymakers are easing monetary policy because they're reacting to the last 6 months of data, which was a slowing-ish economy, but still strong at 5%. That's going to kind of invert because that stimulus effect is hitting the markets. Whether the Fed cuts in September or not, the stimulus effect is already in place because interest rates in the market have fallen, home builders have risen, small caps have done well. So that stimulative effect of the capital markets is actually what matters more than just like a rate cut. So they're going to be, over the next 6 months, easing monetary policy into a bottomed out inflation, bottomed out economic growth. And that's why I kind of think we're Q4 2020-ish about, which was a period where growth was very strong coming out of the recovery, and the Fed was still very accommodative from monetary policy, and generally very, very good for the economy and risk assets. Because if you think about it, that piece that was missing from the deflationary 2010s, which was fiscal spending, which is the demand, the monetary policy ease was there. That's been here since COVID, and now they're adding the monetary fuel to that again. And normally that results in another inflation problem in 6 to 12 months.
How confident are you that kind of going into the end of 2024 that we get rate cuts? And is that, I think you kind of touched upon it, but is it rate cuts in combination with that stimulus spending that's ultimately going to kind of like catapult us, or is it just like the Fed showing that they're going to cut rates and then everybody just gets excited because they start loosening?
It's reflexive. It's both. The psychology is a real component, and the market effects are real. So the effect that a lower federal funds rate has on small regional banks that fund themselves through short-term deposits, if that comes down from 5.5 to 4 3/4 or something with 3 rate cuts, that's meaningful to open up their profitability. It also matters for credit card debt, consumer loans, all these things that are linked to the short-term interest rate. If you knock, 20%, let's say 5 to 5.5 to, 15, 20% off that bill of interest, that's meaningful for the consumer. But I would say it is probably more impactful if you just loop in the psychology of like, oh, wow, Fed's cutting rates. I can go refi my home. I can go, buy that thing, that car, that home that I wanted. That's a psychological component. But then the markets, I think a lot of people confuse what the Fed does with what actually happens in the markets. And to me, that stimulus effect of them just signaling, this forward guidance thing is usually the impact of the Fed action is already in the markets by the time they do it. So there's a good chance, maybe we get to September and to sell the news on the rate cut because the markets have already priced it in, and we've been operating like that for a while. And so that has the effect of easing capital market conditions for companies to issue and raise capital, at this moment in time with the 3-4 rate cuts priced in. And so it's a little both, where it's market reaction plus the psychology of okay, we're going into this new regime of more supportive monetary policy, and it gets people, businesses spending, ordering, investment, things like that.
On kind of the crypto side, to me, as someone that's not as deep in macro, I just look to see when Bitcoin passes all-time highs. I'm like, all right, now's the time. And Bitcoin's kind of surpassed briefly kind of its all-time highs a couple times, but really not like a blow off kind of top where it's like, all right, we're in new uncharted territories. How are you kind of thinking about the crypto side of these assets? Kind of, you mentioned it's more analogous perhaps to Q4 of 2020. I remember from that time, just again on the crypto side, we had a lot of experimentations, DeFi summer. You had compound to liquidity mining that really started a lot of interesting experiments with food tokens. And kind of kicked off this like new form of capital formation. And I personally am excited just to see what happens post all-time highs, because that's really when you get in that price discovery, people kind of going out the risk curve a little bit more into these less well-known assets outside of the majors, going into some more of the applications. But it seems like, to me, again, purely from the crypto side, there's just been a lot of speculation now that Bitcoin's kind of run up, kind of flirting with its all-time highs. A lot of speculation in meme coins, but this really kind of feels like first couple innings, then like this is the end that most people perhaps called for. I can't even remember, a couple weeks ago, 3 weeks ago, 4 weeks ago.
Yeah, sentiment is a funny thing and a useful tool. I do think we are probably halfway, let's say. It's pretty funny how these 4-year cycles just, I'm not a believer. Like, I don't base my views off them, but it just so happens that here we are after a big run up back to all-time highs. That's turned into resistance, and I think we're going to start making a run in the second half again. And it happens to line up. So there's something to that madness you have to trust about these liquidity cycles that there hasn't been enough to be statistically significant, but you have to, give some credence to it. And the reason for that, people talk about, the common maturity of debt is 4 to 5 years, and this refinancing cycle and when it provokes global liquidity. For crypto specifically now, I think that has plagued a lot of people in the space. When you talk about, are we back, are we not? Stablecoin supply has grown, but it hasn't gone bananas. Like in, 2021, it went, or 2020 to 2021, it went from like $1 billion in stablecoins, or 2 or 3 billion to like 60, 70 billion.
I think right now we're at like 160, 170.
Yeah. And at the start of this, in October, we were probably, when stablecoins bottom, I think we're 50, 60, or so maybe it's doubled it, but it hasn't like 10x'd. And, similarly on the alt side, right? We've seen a lot of underperformance in alts and legacy and major dominance, and then memes on the other side. But I do think we are still at that inflection point. It's coming based on, one, this liquidity reignition. So an analogy you can use, again, it's funny, I find these from the traditional world to this world, is small caps versus large cap. And you could say large cap tech is a barometer for that, which is, for the last 2 years, small caps have underperformed and not gone anywhere. It's basically a flat range, which is kind of like how the economy's been. It's just been like fine, and everybody's piled into AI and tech. And then we had this inflation print last month where it was low and kind of put the nail in the coffin on people's inflation concerns, and all of a sudden small caps ripped. And the reason for that is basically that was the like telltale sign for the market that the foot of monetary policy being really restrictive was going to come off definitely, meaning the Fed was for sure going to cut after that inflation reading. And it was very, very decisive, definitive move in the markets. And now the lid's off. Now the rest of the economy, not just the sergeants and the generals of AI and Mag 7, can actually benefit, because we're going into the cyclical uptrend. And I would actually say crypto is, if you think about plotting Mag 7 dominance over the rest of the stock market, it's been exorbitant. It's all anybody's talked about. And the same reasons that power that have powered why Bitcoin and Sol, let's just say Bitcoin, has dominated while all the alts haven't run. And I think you're going to see the same corollary of a catch up.
And so is that, again, for the listeners, is that particularly just because the Fed will signal, hey, we're going to cut rates, and then that entire reflexivity just makes everything kind of be more risk on. And because it has been interesting, as these big tech stocks, specifically Nvidia, have kind of been a black hole for liquidity. And then you see this reversal, and then you see those small caps start to get some breathing room.
Yeah, it really does have to boil down to that and the cost of capital. So as I mentioned before, when we've had this environment where restrictive monetary policy on the economy, it actually hasn't been restrictive for big tech because they actually don't have any debt. So big tech has hundreds of billions of cash on their balance sheet that when the rates go up, they earn more. They don't have debt. And then you have the small, medium-sized enterprise businesses in the US where rates go up, their cost of capital skyrockets, and they're like, oh crap, we're struggling to pay the bills. So then when you get this easing pressure, it's not that the large cap tech does poorly. They still do well. The economy's still growing, but it's more of a markets are different than the economy type of thing where all capital allocation flows went into this one sector because it was a safe place. And now people are like, oh, wow, this other part of the market is investable now because cost of capital is coming down instead of going up. And it's this huge reversion to the mean of like, oh, wow, there's some real value over here. Now that it's investable, oh, and then I want some of this too, and I want this. And crypto's benefits in these periods. Why? Not because there's some secret correlation or linkage between small cap home builder and crypto. It's because cost of capital and liquidity. So the same reasons that they're benefiting is why crypto generally benefits. People look to invest in other parts of the market. What is the other growing asset class that has been hampered by this restrictive monetary policy and tighter liquidity? Crypto is a huge beneficiary. What else is there in crypto besides Bitcoin? And also, how hilarious is it? Similar to last cycle, this was early 2021, where it was corporates putting Bitcoin on the balance sheet was kind of the peak of Bitcoin dominance. And we had that sell-off in early 21. That was like the big scare. And then post that recovery was all alt driven. And Bitcoin it went from instead of 60 to 70K on all-time high, it actually didn't go that crazy. You're seeing the same thing, but with governments. Like I would posit that Bitcoin dominance probably topped this weekend with the Trump, the U.S. talking about Bitcoin, because in all that, people forget that any change, Bitcoin's already accepted as a commodity.
Yeah, what are your thoughts on that? I think we were talking about it a little bit before, and I was talking with some people, and they're kind of disappointed that Trump did not say Bitcoin was going to be like, they were going to buy Bitcoin and put it on the balance. He stopped one short of that, saying that they just wouldn't sell Bitcoin. But I thought it was extremely positive, having most likely the next president of the United States be very pro crypto, which has been a stark stance from the past regime, pushing things offshore, saying that they have rules yet not telling you what the rule is and then suing you. So I came away very positive from that kind of Trump experience. But what were your thoughts in terms of like the market or crypto markets?
Yeah, forget about the weekend price action. I didn't make a single trade. Just stayed long.
Yeah.
And it's just noise. It's absolutely incredibly huge. I mean, to think about just 1 year ago, the US was the poster child for tearing the industry down from a political scale. And then that gives cover for the rest of the world to do it. Europe and everybody who follows the US, most people, groupthink, the majority of people don't have independent views and ideas. That's just
that is very true.
Yeah. So you have to be non-consensus to do well. But here we are. Fast forward, and we have the leading political candidate for president. I mean, it's just incredibly unheard of. Like, forget them buying Bitcoin. It's a horrible decision. Like, it doesn't make sense to buy it, really. But what it means is it enables adoption, and it gives that stamp of approval. The ETFs were the first big move in this push, and the thing I would say is and how I'm viewing it is very transparently, November 6th, the election date, is equivalent or potentially bigger than January 11th, the Bitcoin ETF approval potential date. And the reason for this is the Bitcoin approval was ETF approval was this binary event that was like either Bitcoin's going to get opened up to trillions of dollars in brokerage accounts that no matter how many times crypto native people say, oh, well, you can just buy Bitcoin through Coinbase or something. Like, why don't they do it? Well, the truth is the majority of the world's capital is in traditional custodians and brokerages, and they can't just overnight open up a Coinbase account and put it there. So that was like just not well understood by crypto market participants. And we've seen the magnitude of that. So fast forward today, now we have the Ethereum ETF, the second biggest asset in the space. Again, people are running the same playbook of thinking it's a failure because ETH had outflows, and those outflows were 3x quicker.
ETFs are structurally bullish. I posted this meme. It was kind of like the right curve and left curve, both agreeing that ETF's good, and mid curve was like price going down.
Yeah,
like your mid curving, it's so hard. ETF bullish.
Yeah, and so like the easiest trade from here again is probably you have to assume BlackRock's running the same playbook. Let the price go down, and then put your clients in, and then there's going to be a huge run. Okay, and then you get to November, the election, and it's this binary event. So you can think of Trump win as, let's say it's, I don't know, if he cans Gensler, which he's going to do, and he puts in, I mean, the upside of the space is unquantifiable. Let's say it's 5x. Let's say it's 3x, okay, if he wins. If Kamala wins, 6 months ago, it was, not, maybe the same status quo. It's not that great. It's just the same muddling along. Today, it's moving to she's got to come to the middle to win crypto. And so I talk about this idea of, let's say the Dems held out and it's just their anti-crypto views. So your probability of events going in is, let's say, 50-50, Trump, Kamala. And the one side is just status quo for crypto, assuming, and let's say Trump is a 3x. And if Trump has a 50-50, 0 plus 50% times a 3x is, whatever, 1.5, you average that out. And it's, let's say a double from here in expected value of the outcome. But now what's happening is because Trump is getting so much, and down ballot, all Republicans are getting so much voting prowess because of their views, it's forcing that instead of being a 0 status quo for the Dems to win, it's starting to be, Kamala's got to be, maybe it's a little good. Maybe they fire Gensler before the election. So you get this reflexivity to the point where the buildup kind of comes to that election date, and it's a binary outcome. If Trump wins, this is a huge windfall that can't be priced in one day. If loses, well, instead of a 0, it being a little better. So you think of this probability distribution, and the expected value needs to increase going into that as speculation. And the crypto market prices things about 3 months out because of people always think like, oh, the crypto market's stupid. They don't see things and price things like stocks do that are 12 months out. Now, the reason for that is because volatility. So the higher the volatility, there's a structural reason crypto markets don't price things in as quickly, which is if you know for certain, like almost certain that something's going to happen, but the volatility of, the path is 5x greater, your time horizon has to be shorter. So there's like real financial market principles behind every way the crypto market works. People think it's just like, oh, we're crypto, we're the geniuses and new, but there's like these principles that back it up. So anyways, it's an extremely huge event. People remember that in history, and it's probably what's going to kick off the next very large run for crypto.
Fully agree. And I appreciate the probabilistic thinking. I think oftentimes, especially in crypto, everything people view as binary kind of outcomes, and it's just not cracked even as much as you like to believe in a certain thing. There's always probabilities to things, so I appreciate that as well. Maybe shifting the conversation though a little bit, I think there's this larger conversation right now within the crypto markets about, are there too many venture funds? There's too many venture funds and not enough hedge funds. We need more people to buy these liquid tokens, and there's potentially large misallocation of capital because there's too many people chasing too few deals in the venture side. As a fellow fund manager, what are your thoughts on kind of like the current sentiment as someone that's running a hedge fund?
Yeah, I think that's the direction we're going. It's tough to deny that, but you have to, if you're active in the markets, you can never attribute anything truly, like usually to irrationality. Very rarely there's a reason markets are moving. Like in crypto it's less, but generally there's trillions or billions of dollars of moving behind expected outcomes and prices. And so this whole like, oh, there needs to be more liquid crypto funds, the opportunity is there, and it makes no sense why there's just still way more venture. And it makes complete sense. The reason is historically venture investors have been able to invest for 1 cent token in the private rounds and then launch the token a year later, 10x the liquidity speed of any traditional venture fund, like you would in Web2 or fintech. Normally your venture funds there are holding things for 5 to 10 years and getting a 3 to 4x, and they're ecstatic. Here, people are investing and flipping for 100x's in a year, and they think that's standard. And the reason for that, again, is this arbitrage, right? So early access, you're in the know, you know who the founders are, and that's what you, as a venture manager, offer as your edge, your access, your intelligence and understanding of where the trend is going, the ability to see 5 years out things that are going to be big that aren't even talked about today. But that space has gotten very crowded, is right, but the market's still rewarded that. And we've seen that shift now where alts have underperformed and people, are pulling hair out. They're like, oh my God. And ultimately what has to happen is if the venture returns just don't stack up anymore. And then people will start saying, well, why is that the case? Well, the case is because there's no buyers of your $15 billion FDV tokens while they're generating 100K in revenue. I mean, we're not going to be with the buyer. Someone might on a momentum basis, but those are not investable opportunities for serious long-term investors. And so what needs to happen is the valuations need to come in line. That could take 3-4 years from here. And that will bring in, when opportunity brews, people will step in. Like, it just means that opportunity in the liquid space hasn't been as good as the venture space because of this arbitrage, but that is closing. I still think probably it takes another 2 to 3 years before it really moves that way, but it's clearly, you would say it's very tough for the market to become more venture concentrated than it is today.
Yeah. I mean, I've been talking a lot with other venture fund managers, and I think the thing that I've seen as like the unique differentiator is if venture funds are set up to also kind of have a more flexible mandate to do both liquid and venture. And those funds generally have been able to do fairly well, but the funds that are only doing pure venture historically are having a harder time returning DPI to their limited partners, and those limited partners are asking, hey, where are my returns, especially because the last fund was like a 10x DPI, something crazy to your point. And it is interesting, but I think it overarches the entire kind of conversation of like, what should these things be valued? And it's something that I've been thinking quite a bit about, because for the asset class to mature and get to the size that we really want it to, you're going to need fundamentals.
Yeah.
I think you could kind of put your finger up in the air in the past and say, oh, it's infrastructure, we need infrastructure. And that works for a certain period of time, but especially as we're moving up the stack to applications, people are going to value these things on cash flows at the end of the day. And I think everybody's kind of like holding their breath because they don't want it to happen, but they also need it to happen for more dollars to enter the ecosystem. So it's this weird game right now. And I think, to your point, these funds that are being spun up right now, I think are probably going to do very well. The liquid funds are the venture funds that also have the ability to do liquid, because there's this arbitrage in the market. And I think it's naturally good for the industry, and it helps us mature and be more legitimate because we actually have underlying revenues backing these things instead of a group of VCs that launch a token and a couple billion FTV and no one knows how to value it.
Yeah, it's horrible for the advancement of the space. I mean, there's a reason why Bitcoin has an ETF, and I would argue it has product market fit, and it had sidelined investors see the opportunity. So people in traditional finance are looking at Bitcoin and saying, this thing is $1 trillion asset that we probably think should be valued more than gold. So on that basis, that's a 15x from here. We want to buy that. And now they're buying it. You can probably make the case for ETH and et cetera. But it's hard to make that for a lot of these protocols that are cash flowing $100,000 and they're valued at 3 billion, and their total addressable market in the bullest of bull cases, like, maybe they get to like 10 million revenue or something. So again, it's this idea that if there's opportunity, the money will come. To get these large institutional capital flows, you have to have things valued appropriately, and it has to come in. And again, that whole like game of this arbitrage, it's existed. Why is it existed? Because people want to speculate on momentum and other reasons to hold these assets that don't make sense outside of fundamentals. But it deters, that old saying of like, people don't build in bull markets, and they build in bear, and that's where the innovation happens, because they're just watching prices. It deters innovation, because a team that cashes out, they might have had a sweet idea that it was a new mission critical piece of infrastructure, but they launched at 5 billion and all got liquidity, and now they're 24-year-old deca millionaires. They're not going to build anything else. They're on the beach, and I don't blame them. That's what the market's rewarded thus far. And for the industry to mature, the market needs to reward fundamentals, real building, and that's just part of the process.
Yeah, it'll take some time. I don't know. I mean, I look at some of these valuations. Largely, I mean, there's a lot of infrastructure stuff that is potentially overvalued, and I see these valuations. I'm just like, who is going to buy that? And I do think the market is maturing, and this is potentially is also why you see meme coins doing fairly well. I mean, it's kind of like Bitcoin in a sense, where there's like no underlying cash flows. It's just like, it's there. And structure, it's kind of bullish in the sense that like everybody agrees that there's nothing to this. We're just speculating on it. And so I am personally very excited about kind of that hybrid structure of being able to still do venture deals with the ability to do liquid. I think those funds do well. And then I think it is going to be moving towards cash flows and what type of applications can you ultimately build now that we have infrastructure that is scalable. We need scale, and we need apps that produce cash flows for more and more people to actually come in.
Yeah. And I think what you highlight about the ability to do venture and liquid is really cool. That's not our game, because we're on the macro side, but I think you're right, because the insights you're going to have from all of your diligence in understanding of the private markets and what the newest technology is are going to be very applicable. There's many of the most successful funds do that in the traditional venture world, so it makes sense to have here. An example is when the next big flush, we're talking like bear market for crypto, every coin is going to get sold off, and every new coin is going to get labeled in this like new coin, high FDV, bad token bucket. And so the baby's going to get thrown out with the bathwater. And then you might be sitting there evaluating a private deal where you can invest in a company at 15 million, but their closest comp is already public token. And maybe they got, knocked down to 10 million just because indiscriminately people were selling. And there's going to be crazy opportunity, I think, in that realm, because there's just so many tokens that there's going to be a lot of diamonds in the rough there, probably.
I fully agree. So maybe as we're wrapping up, what are you kind of looking for towards like the next 6 months, 12 months? I think generally people are bullish going into the end of this year of 2024. Some people are calling through like a continued bull run throughout 2025. How are you looking at, say, the next 12 months out?
Yeah. So the things I'm watching the closest, as I kind of outlined, I'm constructive on the economy and the growth when you have these fiscal deficits. It's just not, you can have recessions in that environment, but it's very rare. You'd have to have, if the government's spending 5-6%, you'd actually have to have like really negative growth to offset that. So how I think this plays out is another wave of inflation, which would see a end to the super positive environment for risk assets, similar to the end of 21. How long that takes is the question. My work suggests that actually this next wave of inflation is probably, my base case is likely that it will be worse than the first wave for the US. And two reasons for that are, one, energy dominance. So if you look back to the post-COVID inflationary environment, the US was actually much better off than the rest of the world, than the UK's and then the Japans and others, where they're big energy exporters. We're net energy exporters. They're net energy importers. And so when commodity prices spike, you're in trouble there. And we're actually been almost not investing nearly the pace we have in the past in our energy infrastructure and commodities. For the first time in many, many years, U.S. oil production is actually kind of topping out and potentially declining based on forward production and where drilling activity is. You'd expect U.S. production to probably roll over at least for a period of time in the next 12 months. And so that energy dominance that the U.S. gained in the 2010s since the GFC to now has led to a very strong dollar, right? So the dollar is, everybody's talking about how cheap vacations to Japan and Europe are. These things ebb and flow on cyclical basis, 1 to 2 years, on secular basis, 5 to 10 years. And the reason, alongside energy dominance kind of fading, if we don't continue to plug that and produce, you would then likely see pressure on the dollar. And the other big consideration that people talk about but don't necessarily talk about in this sense is, in a response to COVID, we printed so much money that the Federal Reserve amassed a 2.5 trillion basically piggy bank of liquidity, which is the reverse repo facility on its balance sheet. So you can look that up and kind of understand the mechanics there. But basically what was happening is normally the Fed's providing liquidity to the market. The RRP is the Fed extracting liquidity from the market. And you're like, wait a sec, why would they do that? It's because they literally printed so much money, increased the size of the balance sheet so quickly, they sucked excess reserves out of the market. Over the last 2 years, they put those slowly back in the market to finance the deficits. But thinking about that, similarly how you value supply and demand and things, that 2.5 trillion excess supply of dollars was already baked into the price of the dollar. So as the U.S. has supported its economy with that extra 2 trillion of RRP liquidity the last 2 years, that's not been excess dollars being printed. They were already in existence. And so that's kept the U.S. economy strong, and without us having to finance those large deficits in the open markets. Now that facility is $400 billion, basically. And, going into 2025 to continue financing these huge deficits, we're going to have to either monetize the debt via the Federal Reserve QE again, or issue that debt into the open market, which, to find the next marginal buyer of those bonds, requires higher interest rates, a lower bond price. So basically how I think it all shakes out is the key to watch is inflation. From here on out, I don't think, I don't buy into the growth scare concerns that people are talking recession. I'm very little reason to believe there's going to be a recession anytime soon. And to me, how long this can last is a matter of how quickly inflation comes back. It might, my base case is probably like somewhere early to mid 2025, where you see this supply constraint in the physical commodity world start to actually become more problematic. You're likely to get more geopolitical turbulence. After 2024 was the largest election year in the history of the world. The most people on the planet ever, or percentage of people on the planet ever in history, voted for their new leader of their country. And in those years, you tend to see, peace. People aren't looking to instigate new wars. People are looking to wait for outcomes of the elections before making big decisions of, geopolitical, multi-year kind of things. China, Taiwan, and Ukraine, Russia are examples. Ukraine, Russia started right after the U.S. election in 21. So that's, doesn't have to happen, but generally happens after election years. And so that could also be a thing to spark another inflation problem if you already have supply issues and a hot economy. Because frankly, I don't see, even in that environment, you don't need to see a recession. But remember, financial markets and economy are different. 2022, we didn't really have a recession, but the financial markets did really poorly because inflation came back. And so that's what I'm looking out for. I think what ultimately, until then, I think we have this sticky inflation environment, high growth environment, and now we have loose monetary policy should be very, very good for risk assets. Whether that's 3 months until the election, I have a fairly high degree of confidence in here until the election date. It should be very positive. Then I would say my confidence is in terms of timing kind of phases down as you go 6 to 9 months, and maybe we go 12 months from here and it's next summer or something. But I would expect the end of this, strong crypto run to be another inflation problem.
So bullish for crypto going in throughout the next year. How, I guess, like, without going into exact terms, if the risk is coming back on, crypto generally has the majors, and then you have the kind of alt market that is more risky but higher upside. How are you kind of viewing that playing out from the crypto market side?
Yeah, the interesting thing about this, and again, it's this probabilistic distribution of outcomes way of thinking, which it's tough to communicate on Twitter, but there's actually a real reason why, if we get a huge explosive move above all-time highs, let's say it starts in August or October or something, and if that is significant, you're likely to see a continuation longer, let's say, versus if it's, we get to 75, 80 and kind of spill back because the move wasn't that powerful. So there's reflexive effects in psychology, huge trend breaks. There's usually a reason under the surface why it's so strong, and it can power that. I think, again, similar to how I mentioned before, the peak in Bitcoin dominance, I don't think it's maybe similar to past markets where you could really just spray and pray any alt and you're going to do well. I don't think it'll be that same. There's still more dispersion that will continue. The asset selection is very important, but it's very likely in my mind that the winners stay winners. The Solana ecosystem, there's probably some upcoming potential winners in the areas you focus on. I think like a SWE and things that will do really well when the space gets more into vogue. And the biggest, let's say, lack of continuation of current trend, I would say, is the Bitcoin side. Like, Bitcoin's led this far in the cycle. I would say now that ETH has the ETF, it probably outperforms from here. Again, I think the Sol ETH debate is just silly in my mind, because like Sol is higher beta. It's a smaller asset. If prices go up, Sol's going to outperform. If prices go down, Sol probably underperforms. There's still relative value things to consider, but it's people get lost in that. So I think overall, let's say here to the election, just on the speculation alone that if Trump was elected, all of DeFi could start turning on fee switches, revenue to token holders, and staking is no longer a security. I mean, these are 10x improvements for proof of stake, for applications, for protocols, for DeFi. Stablecoin interconnectivity with the banking system and a Fed master account that allows all of JP Morgan Chase's deposits as Jamie Dimon becomes Treasury Secretary to be stablecoins. I mean, these things are like unpriceable upside events over like 5-year horizons. So I expect a huge speculative boom into that election event. We'll see, sometimes there's sell the news, sometimes there's meat on the bone, and you can continue the rally into 2025. So playing like this tactical 3 months out, I think your focus should be elsewhere besides just Bitcoin. That was the first year of this cycle. And I think it's time to be looking at the value elsewhere.
What I'm hearing broadly is don't fight the Fed. Yeah. The Fed is signaling that they're going to cut, and kind of whether you're on kind of pro-Trump or pro-Kamala, either side is moving towards bullish crypto, which is very good for the industry, and just don't mid-curve it.
Exactly. That's right. Those are the biggest structural forces at play. And where you want to start fighting the Fed, if you're ever going to do it, is when these signs of inflation emerge, or you think they're way ahead of their skis. If pricing gets to 10 cuts and inflation's coming back and there's probably not a chance we're going to get 10 cuts, that's a time, maybe March was similar, where you start, maybe can express other views. But in this environment, they are signaling with multiple months in time horizon, liquidity is coming. it's not just the Fed, it's global. China's doing it, Europe's doing it, Canada's doing it, Australia. Like, this is a global thing. Bitcoin's a global asset that trades 24/7 and benefits from any currency debasing. Obviously, the U.S. being the dominant, but there's forces across the globe that influence it.
Amazing. Well, it's been a super fascinating chat for me, and hopefully a fascinating chat for everybody else listening. Where can people find you? Where can people learn about your fund, prospective LPs? How can they get in contact with you?
Yeah, so I'm on Twitter at QTHOMP. Pretty active some days. It's a fun place to interact with people. The new town square, I think of it as. And then I will be releasing a site pretty soon, lekkercapital.com, where people will be able to follow all my work. We'll be releasing monthly letters, performance. We recently moved from a 506B fund to a 506C, so now I can more publicly talk about it, disseminate performance results, updates, research, and that's generally the place. I believe in transparency and like to put my views out there because it helps me be better and solicits feedback. So if people are interested, just reach out. Always happy to chat and appreciate you having me.
Of course. Thank you so much, Quinn. Really appreciate it.
Yeah,
Thank
sounds
you.
good. Thanks, Logan.